First time we are going live in the Elite webinar, and what a way to start it off. I am here hosting. This is Riz. I hope everyone had a fantastic holiday season, a fantastic new year. Again, thank you for those of you joining live, and it's a pleasure to be on, pleasure to have you. And of course, I am hosting today. Usually it's Chris, but he is off this weekend, and I am definitely happy to be stepping in and running this, even though sometimes I do join him as he hosts, but it's great to be on. Let's kick things off. Well, we've had a tremendous 2021 with the market ending up over around 27% for the year. I had projected that, you know what, we're going to have a good bull run in the later half, and that's exactly what happened. You can see after the kind of this dip that we had in September. Here, this is the S&P 500 with the 50-day moving average in the green line, and the red line here is a 200-day moving average. I had said that, you know what, I think markets can recover around the 4,300 base here. And sorry, here we go, 4,300 base. And guess what? You know what? We did that. We had a great rally after the 4,300 levels. And as you can see, the support area. And not only that, we went into December a little bit sad because we were wondering, well, are we going to see the Santa rallies, as we call it? And many people leading into the beginning of December were like, oh my God, we can't have a Santa rally because look at what's happening. The market is tanking. We got some very bearish candles here. We're going to the 50-day moving average here. We're near the 4,600 level in the SPX and below actually. But the Santa rally actually comprises of after the holidays. So after the 25th is when we see a big rally usually. Or I think the statistic is around 75 to 80% of the time, the market is bullish after December 25th, leading into the new year. And I can just highlight that here, this area. Again, it's not an exact measure, but you get the point. This region here. So we did have a nice increase, and in fact, we went on to hit some all-time highs leading into the end of the year. And contrast that to January 4th. We had pretty much an all-time high if you count the intraday high. So that didn't last long, unfortunately. But of course, I feel like right now this is a reasonable pullback. I will dissect as to what happened, why we are seeing this little bit of a pullback. Again, it's not a crash. I know everyone likes to call things a crash and get very, very, I would say, dramatic with any pullbacks. But this is not a crash. This isn't a big sell-off by any means. It is a little bit of a profit taking, but we are in this range. Now, I will highlight this range here for you, 4,700 area. Okay, again, this doesn't need to be specific. It doesn't need to be exactly to the decimal, but 4,700 area is a key area to keep an eye on. And I mentioned it in Elite. Again, to those of you that have joined the Elite membership over the last couple of days, thank you, welcome. It's a pleasure to have you with us. But the 4,700 area is one that I've been keeping an eye on the last few days. We are just below that and sitting right at the 50-day moving average, as you can see, around the 46.75, 46.77 level. Another area I want to keep an eye on here that I will highlight is the 46.50. Again, just a very basic range. Okay, you can see this range is pretty critical. If the market breaks below the 46.50 level this coming week, the next place we want to keep an eye on in the index is the 4,600. Again, I know it's not exactly a 4,600, this line, but you get the point. It's supposed to be 4,600. There we go. So these are the levels here that I've drawn for you. Please keep an eye on these levels. Why am I making these levels prominent here for you? Because we know that as the market moves up and down, that has a broad impact on majority of stocks, primarily the large cap companies that we know and love, right? Of course, because they're part of the market. In fact, many of these companies like Apple and Microsoft and Amazon, Facebook have a larger, they're essentially a larger weighting of the S&P 500, the larger weighting of the market, simply because the S&P 500 index, as we have highlighted here, is a market cap weighted index. And I find that so many people don't know that, especially some of these quote unquote trading gurus, that blows my mind that they don't know what market cap weighted is, and they don't know that the index isn't equally weighted. So there you have it. These are the key levels to keep an eye on this coming trading week. With that said, why are we seeing this fade? Why are we seeing markets pull back from all-time highs start of the new year? Well, this isn't uncommon. January is sometimes a muted month. It's the start of the year. It's a year where we get to wipe the slate clean, good or bad, from the previous year. And in this case, 2021, as great as the performance was, 27% or so for the year. Okay, the year has passed, the calendar has changed, and now we get to see what happens. Of course, we're in a different market environment. Just like every year, we're in a different market environment in 2022 than we were in 2021. Then, of course, than we were in 2020. So a few key points you want to keep an eye on for this current Q1 of 2022 is inflation and rates and yields, Treasury bond yields. Okay, these are the three key things we want to keep an eye on. You notice that I haven't mentioned anything about COVID or coronavirus or Omicron variant or whatever other variant there may be. I haven't mentioned that in this list because we know that the market has, for the most part, digested anything and everything to do with COVID. I mentioned, in fact, I went publicly, I said on air maybe a month ago with Chris and everyone else that was on and even watched the recording, I said that with the Omicron variant, that if we see cases increase rapidly, which we are, and we see hospitalization decrease or not increase in relative to increasing cases, which is the case. We've seen cases go up, but we've seen hospitalization rates remain the same and not go up at a rapid pace. If we see deaths maybe hold or not increase alongside increasing cases, which is the case, that could potentially mean that this is near the ending of the pandemic. And I know there's like an HIU variant and this and that variant coming out there, but this could potentially, Omicron could spell the end of this pandemic and could mark the endemic, so to speak. So again, I'm not a scientist, I'm not a virologist, I'm not an epidemiologist, but I can tell you based on my studying and research that I spent way too much time over the last 2 years on, tells me that, okay, this could be a positive thing in the glass half full side of things. So the market has factored this in. The market isn't stupid. Obviously, what is the market? It's the coming together of millions and millions and millions of different participants, extremely smart, extremely stupid, institutions, regular traders, and everything in between. Okay, all combined, and that's the market. So the market is overall factored in that, okay, you know what, regardless of whatever variant we're on, humanity will persevere, human beings will continue to live, the economy is what we want to keep an eye on, vaccines will be there, different economic, I would say different economic little procedures or limitations that the governments put on a country basis will be there. So the market has factored this in, and they realized that, okay, we passed 2020, which was the worst, I would think, in terms of COVID, because it was a new thing. And And then 2021, we've already made it through as well. So the market has moved past anything to do with COVID in terms of cases and variants. Okay, so if someone's going to think, oh my God, we got a new variant, market's going to crash, buddy, you're 2 years late. If someone's going to think, oh my God, cases are going up, market's going to crash, you are far behind the curve. Okay, just like the Fed. So it's really amazing how we can really see firsthand, based on market psychology and price action, that the market is no longer factoring in higher cases, variants, and so on and so forth. Okay, enough with COVID. First point, inflation. Inflation has been the big talking point all of 2021, along with the word transitory. The Fed has been using that word transitory. It's been a meme word. It's been a joke of the year kind of word, where the Fed was saying that maybe, this rise in inflation that we've seen in 2021 is temporary. That's the word transitory means, that it's temporary. It's not permanent. It's for the time being. And I have gone on record pretty much almost the entire 2021 saying, no, they are looking at obviously a wide array of data. They have access to data that we don't have access to. But even then, even with all that, even with all their PhDs and CFAs and all their, data and all the experts and everything, they still couldn't get it right. And I said that, look, inflation is here to stay, and it's not for the time being. It's here to stay up and until the Federal Reserve, up and until these economists and these people who have control over policy, monetary policy, come in and do something about it. They have to do something about it. They can't just sit there and call it transitory and just sit on their hands. They can't. And I was right, and along with some others as well. I was right, and I've been saying it again and again, like a broken record, that inflation is here. We need to get it under control. It clocked in around 6.8% the last time we looked at. That is a massive shift compared to the average annualized inflation rate of 3% or 2% on the more lower end, right? That's the usual barometer that the Fed aims for, 2 to 3% inflation. It's normal, it's healthy. That's what the Fed aims for. We are looking at nearly 7%. That is unprecedented, and I think it's been the highest in the last 40 years or something. Maybe, don't quote me on that, but to give you an idea, we are in a different economic environment than the last 10 years, 15 years. I traded through the last financial crisis. Again, albeit I was a bit young and very new, but I did trade through it, for better or worse. So I can tell you that it's a very different time in many ways. So inflation is a key metric. Now, what does that mean? This brings me to my second point, rates. What do I mean by rates? I mean in interest rates. The benchmark interest rates have been pretty much near all-time lows, and the real rates after factoring in inflation and everything is actually negative. So meaning, if you're borrowing, after inflation, you're actually benefiting from having debt. I should say healthy debt, so long as it's manageable after rates. If it's like a 20% interest rate, then no, you're not benefiting. But if it's below 4 or 5%, you're actually benefiting from borrowing capital and using it productively. Again, personally, I don't really like leveraging in terms of borrowing money to buy different things. Margin is different. I'm biased when it comes to margin. But if it comes to buying, different assets, personally, again, there's nothing wrong with it, but it's personally, I avoid buying on leverage, whether it's like a house or whether it's a car or whether it's like furniture. I avoid credit per se in terms of having debt. So I have no debts, right? But margin in terms of trading and leverage in terms of trading and investing, I will use when I see the opportunities. So back to rates. The Fed has now signaled and said that they're looking to raise rates in 2022, something that I also said the Fed needs to do sooner rather than later. And I said that they're behind the curve. And I stand by that. And in fact, the Fed came out and said that a few days ago, which is why we saw this drop. We saw the Fed statements, and they said that, okay, we may need to raise rates a little bit more aggressively than anticipated in the end of 2021, and we may need to raise them a little bit sooner. So the market was factoring in 3 interest rates, potentially 2, but now they're factoring in 3 for sure, and maybe the first one coming as soon as March. And we are expecting each rate hike to be approximately 0.25%. So 25 basis points. Okay. So 0.25%. If we see 3 rate hikes in 2022, you can expect, a 0.75% benchmark rate increase. And of course, that will, the reason they're doing that is to cool off the inflation metrics. When you increase rates, you increase the cost of borrowing, you kind of cool off the economy a little bit, right? You cool off buying pressure. And the hopes of doing that, secondary reason now, is because of supply chain issues. They also want to do it so that we can catch up, so to speak. The supply chain issues come from partially massive demand and also a bottleneck of supply, and that's made it very hard, and that's increased pricing all across, whether it be for cars, jewelry, real estate, you name it. Okay, so that's rates for you. Treasury bond yields are another thing. Bond yields will go up if rates, yields will go up alongside rates. So if rates are coming up, bond yields already signal that, and we'll touch on that in the asset classes. Okay, so this is in the brief nutshell. I know I've been going on for the last 15 minutes about it, but this is a brief nutshell of the S&P 500 inflation rates and bond yields. Moving on, we'll take a look at the Treasury bond yields now. As I mentioned, take a look at this, right? So the bond yields have come up. You can remember back in 2020, starting of 2020, look at this. See the bond yields coming up like crazy. Man, time flew by. I feel like it was last month. I remember bond yields were coming up in February. It started the new year, and everyone was panicking. What happened with tech? Do you remember tech stocks tanked during that time, right? Why? Because as bond yields come up, okay, in this case, interest rates start going up. In this case, as a proxy, it means it costs more to borrow, right? Your cost of debt increases. And what does that do? It brought tech stocks down. Why? Because most are growth stocks. Most are reliant on borrowing. Most are reliant on borrowing to fuel growth, to fuel revenue. So when their costs go up, the market prices that in. The market prices in a slowdown in growth, and that's what we've been seeing. You can take a look at the big uptick in bond yields. Okay, bond yields going up. Bond prices come down, yields go up. Okay, so this is the yield. Okay, so for a 10-year Treasury note, you can expect 1.77% annualized yield. So yield is going up because it's cheaper to buy the bond. Okay, again, we're not going to go into the details of bonds, long, complex topic, but you get the gist. Next, we have crude oil. Crude's been on a tear, on a rally since the start of December. We had a big shock in the, and this was obviously a buying opportunity from around 78 down to 65. It was a great area, I said, that we want to buy. I didn't catch this rally for the most part, besides some of the oil holdings that I already held before. But for those of you that bought around this level, fantastic. Congratulations. This was a great entry point around the 65 area. And now we've kind of recovered from this end of the November drop. Why did this drop happen? Because Omicron fears and jitters is what really caused this drop. So personally, I'm not really a buyer of oil at $78, $79 a barrel. That's just me. Some people do have the projection that oil and commodities could continue higher in 2022, but that remains to be seen. Gold, a very languishing asset. I'm not a big fan of gold as a hedge because it doesn't operate that way anymore. It has a carry cost, and it's just not something that I find to be a productive place to keep capital. And right now it's about 1,800 an ounce. Okay, it's floating in this 1,900 to 1,700 kind of area channel here. The U.S. dollar index. This is also had a nice sort of month in December and then now consolidating. Why is this index? This is just a general comparison of all the major currencies compared to the US dollar. Okay. The value is arbitrary. What matters is look what's happening here. It's holding. The US dollar has gotten stronger. Why? Because the market is expecting rates to go up, and a higher interest rate is usually positive and strengthens the dollar. Okay, so that's asset classes for you. Now let's move into the different sector ETFs of the S&P 500. Okay. Again, there's plenty, but I'm going to go back to 1 year and show you. There's no point doing year to date because it's only been 8 days. I will show year to date in a minute, but first let's go over how the different asset classes performed in 2021. And as you can see, the S&P 500 so far is up 23%. Is actually dipped because this is factoring in a couple percent dip that we had so far. But you can see the actual performance was around 26, 27%. This is the SPY, right? So this factors in a little bit of a variance from the SPX and net of fees. But here we have 22% for the SPY, utilities and healthcare stocks sort of underperforming for the year. And tech also a little bit of a dip here. Or like if we go to the end of December. Okay, here we are. So the S&P 500, you can see here, and then a lot of these companies, a lot of these ETFs just kind of having a massive shift here. But with that said, it's going to go 1 year again. We had a great year for energy, a solid year for real estate and financials, and of course tech, all outperforming the S&P ETF. If we go year to date, what are the ETFs and the sectors that are outperforming right now? Energy, of course, as you saw with oil having a great year so far. The energy sector up about 7%, financials up 4%, and of course the S&P 500 is down. The ETF for it is down nearly 2.5%. Utilities are up as sort of a hedge. Okay, still in the negative for the year, but have kind of ticked up, is negative 0.65%. And the underperformers, okay, take a look at this. The underperformers, negative 5.46%, nearly 5.5% negative for the year so far, 8 days, is tech, XLK, XLRE, real estate, okay, down 4%. And then XLV, pharmaceuticals, down 3.65%. So not a good start for the year for most sectors, especially obviously the broader US market. Now, flipping back, I have for us a few trades that we want to look at that we took this week in Elite. Oops. Okay, and that is Asana. This is a tech company. It had a tremendous rally in 2021 and 2020, so to speak, as well. From when it IPO'd back in October 2020, had a nice rally leading into 2021, and well, not so great after Q2. November was not good. Q3 and Q4 was not good ideally for it. Big sell-off, and it's holding the 61 level. We took an entry. We did trade this at the end of last year, I believe, and we did made some money, but we've gotten back in, and this is a good entry. I think this is a little bit more of a risky play, but we got in around 61.30, so right near break even still. I'm hoping to get to the 67-70 area, and then the second profit area of 78-80 zone, right? This is where we want to kind of see it run up to. And I think that's possible. We just have to give it some time, especially with what's happening to tech stocks, right? It's not a surprise that tech stocks have been getting hammered, and this is one of them. Okay, so this is a recent trade that we took. Another one I'm going to outline that we took is MDT. This is a medical devices company, another fantastic company. This is obviously in the healthcare devices area. This is a very solid, fundamentally solid, large cap company. This is oversold, from September onwards. Very, very sharp and continuous decline. I'm hoping this downtrend has been broken. And now it was reached as low as 25%. And back to November 2020 levels, right? So that's a big erasement. It's erased pretty much all of 2021 gains. So this is a good entry. We got in around 105.58, just near break even right now. So keeping an eye on this one as well. For those of you with the questions in the chat, just bear with me here. We will touch on that get to Q&A shortly. So those are the couple trades that we took recently. I am going to highlight a couple companies here to watch. Again, we know there's massive amounts of opportunities in tech. So I'll kind of differentiate. Like, I'm not going to pick something like Amazon, even though as great as it is. It's a great entry. I think, 3,200 is the next area to keep an eye on. If we can get there, that's a great entry. But again, these are some of the more common stocks that people look at. So I won't really bring those up. I'll try and share with you a few different names that maybe you might not have on your watch list, or maybe you may not have thought of. And of course, ones that I don't already own. So CRM is one, but I'm not going to really go into that because I already have a position in that for those of you that are in elite. But a couple that you want to maybe keep an eye on is TXN. Okay. Again, this one has a tremendous year so far, but right below this channel, this long-term channel, okay, this consolidation channel, if you want to call it, here. So it's right below that. It's below the 200-day moving average, and it's near this critical point of 180. Okay. I think this is a good area to keep an eye on. I'm not saying go in now and get in and you know what, buy this up. No, I'm saying keep an eye on it. Another one you may or may not have seen is Shop. Again, another big company, but hey, maybe you haven't looked at this one for some time. This one's getting massively demolished. Again, this had a tremendous year. I think it's way overvalued, but from a trade standpoint, from a technical standpoint, this 1,100 to 1,000 area is a key zone. So keep an eye on this area here. Okay. If we can break through, this could be setting up for a good potential rally, so long as it finds a floor and that market stabilize. If markets go lower, especially tech going lower, you can, bet that Shop's going to go lower. So please keep that in mind. Those are the two companies that you can consider keeping an eye on this week. And further, another company, again, a large cap, okay, is Starbucks, sitting right at that multi-touch point support near 107, right? So this is looking like a good setup. Again, based on broader market. I never say, okay, just go in and get in now. Like, this isn't how we trade. We don't trade like we're trying to trade some pump and dumps. These are all large caps. These are all solid companies, or I should say large companies. They're not going anywhere. But you still want to use proper risk management. You still want to use proper risk metrics, and you want to use proper position sizing. And of course, get in based on the technical measures that you look at, right? For me, I'm looking at support, I'm looking at resistance, I'm looking at maybe starter positions and finding out when a stock can find a floor and going from that, right? So keep an eye on that. Last but not least, mRNA. This one, man, it really benefited, obviously continues to benefit from the vaccine, production, COVID and whatnot, but this is setting up to be a big area right here. And the stock moves really big. It's had a lot of movement over the last few months. You could see this big move, right? I hope you could see it here. It's a big move, a lot of volatility. Look at this candle just to give you an idea, right? So although the stock has cooled down, of course, we know there's still one of the two major producers of the vaccine, Pfizer and Moderna, whereas the other ones, AstraZeneca, Johnson & Johnson, and whatever else there is not really as prominent. They're not really as favorable as these two. So Moderna is one of them. And of course, you want to keep an eye on this from a technical standpoint, the 200 area especially. Those are my kind of trade prospects, trade ideas, if you will, for this coming week. Now, hopefully, let's get into the Q&A. Some questions. I'm looking at the chat room here. Let's start with Francis. He has a question. Would I invest in real estate in syndication? Of course, it depends. It's a very broad question. Would I invest in it? Of course, very much depends on the details. the details in anything real estate or pretty much any deal, the the details and the specific stuff will effectively make or break me, participating in it. So if the terms are favorable, the details and the specifics are good, then yeah, sure, I would. But again, I can't really comment on that based on just general questions. So next question is, in regards to the options course, do we need a bigger account to use the methods? This is a good question. The options trading masterclass, I cover, from start to finish, pretty much everything to do with options and all the major widely used option strategies. But the one that I use most is the Raptor method, which is what I call, and it's effectively doing short puts and then covered calls. And that's really what I call the Raptor method in a nutshell. And Tom's asking, is it better or is it ideal to have a big account? And I would say if you have an account size of $10,000 to $15,000 or up, I think this is perfect for you. I think the Raptor method for anyone that has more than $10,000 to $15,000 is perfect. I think it's a must. I think it will change the way you see and operate in markets. You can literally derive a monthly or even a weekly income from doing this. Okay, it's amazing. It's just like literally a cheat code. It's like literally like a hack for you to make money in markets alongside the regular trading that you do with options and alongside the regular stock trades that you do. So yes, hopefully if you have a $10,000 to $15,000 account with margin capabilities and options capabilities, absolutely. If you have a $5,000 account, or maybe you have an $8,000 account, I think you could still obviously benefit from the content and the teachings and learnings in there. But it's definitely ideal to have, $10,000 to $15,000 or more in your accounts. And of course, when you have margin and leverage capabilities, even more so. Panos has a question here. Could I look at DGX? Okay, absolutely. Quest Diagnostics. Okay, a great company. Now, of course, this massive sell-off to, start of the year of 10%, big haircut. I think this is a great opportunity. I just kind of feel like, where is the floor, right? It's a sharp sell off. Yeah, we're at the 50-day moving average. Can it hold? This is a potential support area. Can it hold, right? So Panos, this is a great trade idea, so to speak, a great opportunity, something you want to keep an eye on once it finds a floor, like you said. Netflix is another. This is also a great opportunity. Again, there's so many opportunities abound. Like there's no way I can hit them all in one webinar. But yes, this is a great tech stock. Obviously, we know and love. Again, very much a growth stock. Doesn't make any profit. This 520 area is what I'm keeping an eye on. I had looked at it last week before the end of the year, and it's only gotten better. But yes, I think below the 200 moving average, we want to see if we can find a floor around the 520. I will most likely be doing short puts on it, the Raptor method on it. Okay, wink, wink. We have a question from Dylan. Okay, let's take a look here. Dylan has a question here of Baba. Okay, boy. I've traded Baba. I had it, took a loss on it. And I said, okay, I made an exception for Alibaba. I made an exception because I said I wouldn't trade Chinese stocks or invest in Chinese stocks. And I made an exception with Baba because it's a large cap and it was oversold and blah, blah, blah. And of course, regretfully so, I wish I didn't. But I have since, when I had a position last year, I closed it for a loss. But as far as what's happening now, I think the momentum's come in. There was news that Charlie Munger of Warren Buffett and Charlie Munger fame, that Charlie Munger has taken a position. Again, that's had a positive effect on the stock price. I'm personally not a fan. I have pretty much said that for my New Year's resolution, so to speak, trading resolution, I would say I'm not looking to buy or trade any Chinese stocks this year for the foreseeable future. Okay, that's my take on it. Michael Ross asked about PayPal. Michael, you will be happy to know that I have a position in PayPal. It's in the red. It's dropped below after my entry, but man, this is looking really nice. This is looking real nice. The reason I didn't bring it up is because I already have a position. So I don't really go into uh, trade ideas of positions I already have that Elite members are aware of. You will see my list of open positions in the respective channels in Elite. But yes, this is a great opportunity. I think it just needs to find that momentum. Needs to find that momentum. The fact that it's holding the 180, 187 area here, this consolidation is great. It's fantastic. It just needs that push. It just needs that momentum to come in, and I think it can do really well. Okay, hopefully that gives you an idea of my thoughts on it. ENB and CAT for the year, Hugo asks. Enbridge, fantastic company. I actually have some in my Canadian TFSA RSP as well as my wife's. Sorry, wife. Sorry, honey. I hope you're not watching this for giving away your positions here. She had a fantastic year, actually, since she married me. She had a fantastic year in terms of performance after she married me and after I started taking over and looking after her TFSA with over 120% return in 2021 year. But anyways, she actually had a better performance than I did. Okay, but I can't take credit for that officially because that's her account. But either way, Enbridge, great solid company, especially if you're a Canadian. It's an awesome company, not going anywhere. It's great for you holding in a TFSA and RSP because of those dividends. So that's my thought. As far as getting in now, I think you missed a little bit of the boat. I bought for myself and my wife around here, 37 area. This is the US dollar ticker. So I bought around the Canadian equivalent of this. It's had a great recovery. I think it can continue upwards, but it all depends on what your thesis is. If you're holding it as a trade, I don't look at it as an opportune setup. But if you're holding it for, the dividends and for long-term hold and in a tax-efficient account, then yes, I think it's a great stock to hold. Do your due diligence though. Caterpillar, great company, fantastic company. It's been languishing and kind of consolidating in this little bit of a downward channel here for pretty much half of the year, but it's nice, big, bullish breakout at the start of the year. So let's see if we can reclaim those highs. I avoid buying on breakouts, just me personally, but I think if you're looking at it from a trade standpoint and from a momentum trade, I think this is looking like a good setup. Again, it's a large cap, solid blue chip, industrial manufacturing stock. It's not going anywhere. I can't fault anyone for buying and holding this for more of a long-term standpoint. Okay, continuing on. Robert adds, Riz, is it worth DCing into large cap stocks in a Roth account? Absolutely. If you're holding in a Roth account, I'm assuming it's for long term. If you're DCAing dollar cost averaging into large caps, again, large caps is a very broad thing. There's hundreds and thousands, if not thousands, of stocks that are technically large caps. But if you're looking at the solid ones, the solid blue chip ones, yes, absolutely. You can't go wrong so long as it's for long term. I personally prefer to be more strategic with my entries and exits. But of course, if it's for a Roth account, yeah, you have my blessing. Should we sell naked calls on GME to start off the year with the bang? Liam, mate, listen. Liam is fantastic. He's been with us in Lee for a long time, and he, alongside me, went through a very tough time with GME last year. I think 2 or 3 weeks from now is going to mark the 1 year where I lost $160,000 in a GME blow up. And I showed the video of the losses as well for transparency. But yeah, he's joking around. No, we will not be shorting naked calls on GME or anything actually since then. Got a question from Johnny. Wish is almost at $2. You previously mentioned the company to its comparables. It was undervalued like at 6 and 7. Yeah, it's still undervalued, but what do we know? We know that the market is completely unfavored it. I took a loss on this along with many others. It's at the point, it's $2.76. It's at the point where the market doesn't believe in the business no longer how great the valuation is. They had a CEO shakeup just recently. They had some management changes recently. Their last earnings were not that great, but not completely horrendous either. We know that their business is also taking a hit because of the change in uh, advertising content. Like we know that the changes Apple made, for example, to ads on different apps like Facebook and all the privacy related stuff that's really shifted the dynamic of media buying and ads. Wish used to spend approximately 1 million, okay, dollars, 1 million to 1.5 million US dollars a day on ads. Okay. So you can imagine spending half a billion on ads. I'm sure we've all seen those Wish ads, those obscure products, from downright crazy to downright creepy. But they worked. Those ads, they used to spend 1 million to 1.5 mil a day, and nearly $500 million in ads. That's not the case anymore, and that's not the case because the different changes in ad policies and privacy, and as a result, Wish has obviously taken a beating for other reasons, but that is just one of them. But you know what? In terms of undervalued, when do you take a starter position? I would not touch this right now. I was wrong on my thesis in thinking that the market will eventually, become favorable. It will eventually see that this is kind of like a brutalized pig, and at some point can turn into something less of a pig, maybe a pig with lipstick. But nonetheless, it's not happening. I don't think it's going to happen anytime soon. The way that's going, as you can see, I would just avoid it for now. I think there's better use of capital elsewhere. Okay. Scrolling down. Oh my goodness, a lot more questions. I thought that was it. Looking at SQs. SQ is another one. Is another great company now called Block because Jack Dorsey decided to be a little bit extra and change the name just because Facebook did, and then all of a sudden goes and calls it Block because it's the blockchain. How 2021 can you be, Jack? But either way, $141. SQ it hasn't found a floor, and I'm glad I didn't take an entry yet. But hasn't found a floor. I just feel like the opportunity gets better and better for sure. But as great as the opportunity is, we know the opportunity can get better. So I'm waiting for it to find a floor. But you're right. This is another one that is very much depressed. We got to find it once we see a floor. And once it does, I will be ready, salivating at the mouth. Okay. MSFT, Jazz. Haven't touched on it. Another amazing, phenomenal, tremendous stock. It's had way too much of a Fast and the Furious rally for me to enter, even on the little pullbacks. But this is a nice pullback. This is a nice pullback from the highs of around 10%. That can potentially be a gift in the long run. I would like it to go a little bit lower, Jazz. Personally, I'm a little bit more aggressive in terms of the pullbacks that I like to see. And as great as a 9 to 10% pullback from the highs on Microsoft is, coming down and kind of filling this gap up here, I would like to see it get to 300. I think if it gets to 300, it'll be great for a long-term type of account, long-term entry. But will we see that? I don't know. That's the thing. I find there's so many amazing opportunities in growth/tech stocks. Microsoft is literally one of the best tech stocks, one of the best profit-making machines out there, and management and company and everything. I love everything about it. But yeah, from a trade standpoint, I'd like to see a bigger pullback. Jazz asks, what MAs am I using? 50 and 200. Okay, 50 is the green line, 200 is the red on here. Francis asks, thanks for answering my question. Absolutely, Francis, just send me the details in the Elite. You have access to me, of course, as a member. You have access to me, so absolutely feel free to send me a message. I respond to all messages. As you already know, I do my best to be active in the chat and have fun and cooperate and obviously share my trade ideas and my positions and my thoughts on markets. But of course, I'm all for interacting with members and having a good time. And of course, any questions that they may have, I am very much happy to answer. I hope you have enjoyed it. It's been a tremendous, tremendous, amazing first session, first webinar. I'm glad to be, you know, have the first webinar in the Elite for all of you, especially all the new members. Thank you for joining us. I hope you'll stick around. I hope you're enjoying the value and the content and the way we do things. And it's only going to be better as the year goes with all the positive changes and updates that we will be making. I'm super excited for that. For those of you that didn't join and you're watching the recording after the fact, wow, it's a shame. It's a shame you didn't join. I'm a bit sad. I hope maybe the next time in spring or summer, whenever we decide to open up, again, limited seating, limited slots. Hopefully you'll take us up on the offer. Hopefully you'll decide to level up and take things to the next level and be a part of the community that, frankly, hands down, is one of the best, if not the best, because I've seen what's out there and it's absolute fucking garbage. But yeah, enough about that. Thank you everyone for joining. Absolutely stoked to have all the new members. Thanks to everyone, especially the new members. But of course, I cannot thank all the OG members, all the longtime supporters, all the people that have invested in themselves, who have taken the markets and the opportunity by the horns, okay, that have empowered themselves and have learned the concepts and strategies that I and hundreds, if not thousands of others use each and every day to benefit themselves, because really that's all I want. I want to empower you, and so you can live the way you want to live. It doesn't have to do anything with buying things or, flexing or items or materialistic shit. I don't care. I just want you to be financially well off and in a position where you can do whatever the fuck you want without having to answer to anyone. Okay. So as always, it's been a pleasure. Thank you. Again, I hope you've had a fantastic start to the year. It's been a pleasure. Please be safe, be well. If you're watching the recording, thank you for watching the recording. Thank you for putting the time and effort in. I hope, whatever the case is, if you are in Elite or not in Elite, you at least join us at some point. And keep growing, keep learning, keep making money, and keep honing your craft. 2022 is going to be a year for the books. Keep at it. Thanks a lot, everyone. Much love. Ciao.